Hey there, Blockhead traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of January 18th, 2026. And in this week's episode, we are going to continue on our investor mini-series into episode number 2. And in episode number 2, we are going to do a deeper dive on understanding risk and risk tolerance, because everybody's risk tolerance is not equal. And we're going to start talking about the different asset classes and different investment products that you can go after and learn more about, and the associated risk affiliated with those, and how it kind of stacks up across the board, so you can kind of understand, based on your risk tolerance that we talked about in last week's episode, what type of products you might want to look into, you might want to invest in. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, so say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you'll find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts, so look us up, subscribe, and if you can't find it there, let us know and we will get it there. But let's hop to this week's episode. Now, I'll put a link up above to episode number 1. If you missed episode number 1 in this mini-series, this is a continuation of the mini-series. The first episode is about just getting started and opening that first brokerage account, that first investment account that we're going to deal with. In this episode, we are going to understand assets and their associated risk. So also in that first episode, we talked and introduced the concept of risk and what that risk is, and gave you something to think about when it comes to your risk tolerance and how to think about that. Because it's not something that everybody will have an answer to right away. It's definitely something that you have to think about, you have to feel, you have to understand, and that's going to change over time. And so in this episode, we're going to assume that you have understood your risk tolerance, because as we talk about different assets and asset classes, we're going to then talk about the associated risks against those. Then, of course, we have the upcoming episodes 3, 4, and 5 that have yet to be released. So you can look for those in the playlist as they come out. And they're going to cover other building blocks of going into this investor mini-series. Risk. This is something that is not super straightforward to quantify or super straightforward to understand exactly what it means for you. Every single individual is going to have a slightly different interpretation of risk, is going to have a vastly different response to risk, and is really going to vary. And so think of this episode as really kind of calling out at a high level different abstract thoughts around risk, to give you things to think about, things to go research a little bit, things to read up on, and understand how this stuff actually pertains to you is going to be a question that you are going to have with yourself, and an understanding that you're going to have to do on your own. But let's go ahead and start with, what is risk and how do you identify your tolerance? Now, we talked a little bit about this in last week's episode, but we're going to dive in a little bit more here. And where this comes in is there's a risk and reward balance. So think of it like a teeter-totter. On one end of the teeter-totter is risk. On the other end of the teeter-totter is reward. And so the heavier that you make that risk, the more risk that you take on, it's going to elevate that reward on the other side. So the more risk that you have, the higher the potential for a return. Now, the flip side of that is, the more risk that you take on, the more probability that you will not realize the return. But when you do realize it, it will be of greater. And so it is a very much an inverse relationship between risk and reward. The higher the risk, the higher the potential reward, but the lower the probability of getting that reward will be. And so this balancing act is something that each individual investor is going to have to grapple with on their own, on what is their comfort level of what level of risk to take on for that potential gain in the future. And that is quite simply what your risk tolerance is. It is your comfort level with the loss or prospective loss relative to the possible gains and the uncertainty that surrounds it. So you can ask yourself, are you willing to surrender X for the potential of getting Y. Y is not a guaranteed thing, and there is a probability that is associated with obtaining Y. So the question is really about how big of X are you willing to surrender for the potential for that Y. And that internal thing is what you really have to ask yourself. And you'll understand that as you pull up potential investments, potential return, rates of return, all of that stuff. And you'll start to understand what makes you feel more comfortable. I am willing to set forth this $100 on the grounds that I have a 95% chance of getting 4% return. That's one of the equations. Or maybe you're willing to put forth that $100 on a 50% chance that you're going to get a 40% return. Which means a flip of the coin, you might lose that entire $100, but if you don't lose that $100, you're going to get $40 more. And that really is the type of thing when you look at the investment options, when you look at different financial products, that's how you're going to have to think of these things. You're going to have to look at it to say, am I willing to give up X, whatever that number is, for the probability of obtaining Y? And that Y is going to be a rate of return on that original X that you are putting at risk or putting at on the table in order to gain Y. Now, when it comes to that risk that you're putting on, that X that you're putting down, you're putting down X on the table in order to gain the potential for Y. There's going to be two aspects, and we touched on this last week, that is going to hit you as far as understanding your capacity of that risk. There is two components to that risk. Those two components are the financial capacity for that risk, and then the second component is the mental capacity for that risk. And what I mean by that is the first one is much easier to understand. This is, can you afford the risk? This is simply looking at that X and saying, if X is completely gone, if it disappears tomorrow, am I okay with that? Means not in your brain, not how you feel about it, but just if you look at your upcoming expenses, what are you saving for? How far away is that? If that X was not part of that anymore, are you okay? And that's where understanding what we talked about in episode 1. What are you saving for? Do I need this money that I'm putting at risk on the time horizon that we're thinking about? When do I need it? What happens if that money goes completely away? This is going to help you understand your financial capacity for that risk. It's not going to tell you whether or not you're going to be comfortable with it or not. That's the mental capacity for the risk. This is just fundamentally, if this dollar amount disappeared tomorrow because your bet, your investment didn't pan out, are you going to be financially okay with it? Or are you not going to be able to pay your grocery bill, pay your electric bill, be able to take that vacation that you want to take, right? This is the financial capacity for that risk. And this is pretty easy to objectively think about. Now, the second piece, which is the much more difficult piece of the component to understand to risk, is what is your mental capacity for that risk? And this is really, can your body, can your brain, can your focus handle the level of risk that you're taking on? Because it's one thing to look at paper and say, oh my gosh, I can get a 300% return. I can get a 3,000% return. Yes, please. And you're not understanding, or you're not fully realizing or appreciating the impact that you might have on your psychology around losing whatever it was that you put up on that. So you can try to measure this by thinking about it, but really what you're going to find is you're not really going to know until you get into a situation and understand how you react to it. And the two aspects that I really kind of think are helpful when it comes to understanding your mental capacity for the risk is think about, are you going to lose sleep over this, right? So if you lost 30% of your funds in your account tomorrow, are you going to sleep okay? Or are you going to worry about it? Are you going to have this sinking feeling in the pit of your stomach? And that's going to help you gauge what level of risk you are mentally prepared to handle. The other piece of that is your focus disproportionately on that risk? So, for example, if you open up a particular investment and all you can think about every minute, every day is how's it doing? How's it doing? How's it doing? Where am I at? Where am I at? Right? That might be a sign that you are nervous and your mental capacity is not able to handle that risk because it's going to distract your everyday thoughts. So these are the two areas that you can think through ahead of time to hypothetically say, if this disappears tomorrow, am I okay with that? How am I going to sleep at night? How am I going to think about that every day? But in reality, humans tend to underestimate or overestimate, I should say, their capacity for this risk because it really feels different when you're actually in it. And so this is where, as you open up your investments, as you open up things, you're going to find your own risk tolerance, and it's going to be a trial and error procedure. That's why I would err on the side of more conservative and then build up into risk versus starting with very high risk and backing yourself back down. Because if you start out beyond your risk tolerance, you could get really impacted mentally, and it might give you gun shy and might scare you away. Whereas if you start conservatively and build up to it, you are going to build more muscle memory, you're going to build more exposure, you're going to be more comfortable over time. And so I would always say to try to err on the side of more conservative aspect when it comes to risk, especially when you're starting out and you're not understanding how you are going to react to this. So now that we have some of the basics of risk and the components of risks out of the way, we can then start talking about what are the type of products, what are the type of asset classes that we might want to put our money to, and where do those fall on the risk scale. And the way that I like to approach this is really starting with big rocks. And a lot of times those big rocks are good enough to start with. And only as you build up over time do you want to start breaking those rocks down into smaller pieces. And that's the beauty of the investment world and the way that all these financial products are out there. You can get a one-size-fits-all type of financial product, which is a very large rock, and you can be perfectly content with it, and that might be all your investment portfolio has. Or you might be the type of individual that wants a little bit more granularity, so you might want to break that particular rock into smaller rocks and deal with those. Or maybe you're even more granular than that and you want to take those smaller rocks and break them into pebbles. And maybe you want to break those pebbles into gravel and so on and so forth. And that is really where you can continue to decompose a lot of these products into a wider variety or a wider array as we drill down. And so that's the idea that we're going to talk about as we go into these assets and these asset classes. This will give you a pretty good idea of where you start and then the path on where you can learn more. As we get into building a portfolio in subsequent episodes, I'm going to say start with the big rocks. Once you're comfortable with that and once you're ready to drill down into more pieces, then you're going to break them apart. The analogy that I like to give here is maybe you want to try a certain type of food, but you're not sure whether or not you're going to like it. And so maybe you end up going to a buffet or a restaurant that has a buffet where they have all different types of food out there and you have one price and that gives you access to all these types of foods. And you get to try them all. You don't have to worry about, oh, I picked the wrong thing. That was a complete waste of money, because you can go and maybe something else that they offer is perfectly fine. Once you understand what the composition is, what your taste buds are, what you like, what you don't like, then maybe you start drilling in and say, you know what, I don't want to pay for this entire buffet when really all I want is the dessert section. Or, you know what, really all I want is the appetizers or maybe vegetables or whatever it is. And then that's where you can kind of break down. So these big rocks are going to be these type of investments that are all encompassing of many, 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 many things all rolled into one. And that's going to give you a return, but it's not going to give you huge returns until you start zeroing in on certain assets or certain types of that. And that's really where we're going to start at discussing the big rocks. And I'm going to show you how those big rocks can break down into smaller rocks and smaller rocks into smaller and so on and so forth. And you can take that into breaking it all down to fine powder. When it comes to big rocks, I would say there are 3 types of big rocks. There are cryptocurrency assets, there are stocks, and there are bonds. Now, this is all about beginning and getting started and understanding, where your risk tolerances are and things like that. So I'm going to talk a little bit about cryptocurrency assets, although I'm going to advise that most of you stay away from cryptocurrency assets. And we'll talk a little bit more on that. But largely, they are very new. They are very high risk. They are very high potential reward. And there is little oversight. There is little regulation around them. These are going to be your tokens, your Bitcoin, your Ether, your Doge, just all of this cryptocurrency assets. They're going to be different tokens. They're going to be NFTs, non-fungible tokens. I mean, just all kinds of stuff. You've probably heard about them in news stories. You've read about them. They can be very, very, very rewarding. So they can return 3,000, 4,000%. But the probability of that type of return is very, very low, and they have a much higher probability of losing the entire investment that you put into it. Whether or not that's the actual performance of the asset or maybe the exchange that you're trading on is a sham because it's not regulated and they can walk away with your money. It is a type of asset class that is building. It's becoming more mainstream. And so maybe in a few years, there will be a lot more products out there that are a little bit safer for the type of investing. Like I said, I tend to err on the side of conservative. There are now starting to be funds that are regulated that dabble in cryptocurrency. Those are much, much, much better than trying to get into the direct cryptocurrency themselves when it comes to the aspect of safety. But that is an asset class that is growing in a lot of portfolios where 15 years ago, 10 years ago, that wasn't a thing that anybody ever considered. Everybody said, you got stocks, you got bonds, that's it. Now you have these cryptocurrency asset. It's kind of like a currency. It's kind of like a stock. It's kind of like a lot of things. So it is kind of its own thing. But that is one of the large rocks that is an asset class to look into. The next one is probably the one that everybody is the most familiar with: stocks, shares of Apple, shares of Microsoft. This basically publicly traded companies. And when you purchase a share of the stock, you are purchasing a percentage of that company's ownership. So when you own shares of a particular company, you literally own a piece of that company. Now, it's a very small piece of that company, but that gives you voting rights. That gives you influence over the decisions that that company puts forth when they go to vote from shareholders and things like that, because you are literally a partial owner in that company that you hold. Now, there is a lot of oversight here. There is a lot of regulation. There is the SEC, the Security and Exchange Commission. There is rules, laws, governance. Okay, this is a very, very safe place to be in when it comes to putting your money. Now, there are certainly more risky areas of stocks and there are safer areas of stocks, and that is taking that large rock and breaking it down into further chunks, which we'll talk about in an upcoming slide. Now, the last one here are bonds. And this might be something you have heard about, but maybe don't quite understand. Maybe you do, but this is typically the area that is a little less known than stocks, but more known than cryptocurrency. So bonds are effectively an IOU coupon. It is a coupon that companies issue and people buy them, and that what they purchase is they're purchasing that IOU, and that IOU is a partial ownership in the underlying total thing. So, for example, let's say a company wants to raise $10 million. They're going to go out and sell $10 million worth of bonds. Now, each one of those bonds is going to be a portion of that $10 million loan. And those IOUs are going to be broken with two components. They're going to have a coupon rate and a maturity date. And that coupon rate is going to effectively be an interest rate on the loan. So depending on how credit worthy that company is, depending on how risky you think it is, that coupon rate is going to vary. Back to the risk and reward, the riskier the loan, the higher the coupon rate. The less risky it is, the lower the coupon rate. So a company like Apple has a large cash balance. They have a lot of things to secure that loan. They're not measuring, or they're not taking that loan out on future gains that may or may not happen. So they're going to probably have a much lower coupon rate when it comes to that when they issue bonds, if they do. Whereas another company, which is going to maybe rely on future revenue to pay back the particular bond issuance might have a much higher coupon rate because it's less certain that they're going to be able to pay that back. And so that coupon rate is going to be the interest payment on the IOU. Now, every bond is going to be structured a little bit different on how you collect that coupon rate. Sometimes they're collected up front, sometimes they're collected quarterly. It really depends on the length of time and stuff with the bond, but that is a component of it. The other component is the maturity date. The maturity date is when is the IOU due. So this might be a 1-year bond, a 10-year bond, a 30-year bond, which basically says at that maturity date, the original principal is given back. So you're going to collect that coupon rate over time, and then at the maturity rate, you'll get the principal back. Again, this is a very, very mature area of the market. There's a lot of oversight. There's a lot of regulation. This is very safe when it comes to it. So in the scale of risk of these three big rocks, cryptocurrency is by far the riskiest. Stocks are now going to be a little bit less risky. Now, there certainly are stocks out there that can be just as risky as cryptocurrency. Don't get me wrong. Doesn't mean that all stocks are equal. We'll talk about that in the next slide. And then the other safer area are going to be those bonds. And they're safer because there's a contractual obligation to pay those bonds back. There is leverage and court proceedings. Yeah, of course they can go to bankruptcy, but you have a stake in that debt. So when a company goes bankrupt, for example, and they don't have enough funds to cover all the debts that they have, when it comes to collectors of the debt, the bondholders are serviced first before the individual shareholders of a company. So if a company doesn't have enough money and they go through bankruptcy, bondholders are taken care of before shareholders. So shareholders have a higher probability of getting absolutely nothing from a bankruptcy, whereas bondholders could get absolutely nothing, but they have a higher percentage to get some of that principal back. Additionally, a lot of times they don't ever need to go to bankruptcy and the bonds actually get paid back. And that's where your coupon rate is going to come in. So how do these three big rocks start to decompose into larger rocks below the surface? And what do you do with these type of things? So cryptocurrency, these are going to be kind of broken into, they can be decomposed into many, many things, but to keep it very simple, I put them into two buckets. They have what I'm going to call niche tokens or new tokens, not very highly traded, kind of just brand new minted out there. These are going to be things that you might have heard like Dogecoin. They don't really have a lot of practical application. They've basically been out there in circulation and minted, and they don't have a lot of high adoption. These are going to be absolutely the most riskiest area of things. Now, there's other aspects of cryptocurrency that are more mainstream tokens. This is going to be your Bitcoin, your Ethereum. They are certainly still risky and certainly still volatile, but they're going to be a little bit more mainstream, a little bit higher volume, actually a lot higher volume. These are the type of things that are starting to get rolled into bigger financial products that are getting traded on the exchanges today. Now, there's a lot more there, and if you really are into cryptocurrency, I encourage you to do your own research on there. But because this is really focused on investors, because this is focused on beginners, this really isn't an asset class that I would recommend that anybody really start with. Maybe you build a very small percentage of your portfolio in the future in this area, so you have to know it's out there. You have to kind of know a little bit about that big rock aspect so that you can start drilling into it when that time comes for you and your personal tolerances. Now, if we get into stocks, I'm going to kind of give a wide array of stocks here on how we can break some of these things down, because stocks cover so much. And even the ones that I'm calling out here are by no means the maximum extent of what might be called out. It's just where I want to start. And so starting at the top of the list here, these are going to be the riskier side of things, and they're going to get safer as we move down this list. So the first one are going to be your individual stocks. This is also going to include futures, commodities, options, basically anything that is focused around an individual company or a derivative of an individual company. This is buying Apple, buying Microsoft, buying Tesla, trading Tesla options, trading Microsoft options, looking at oil futures, looking at natural gas futures. All of this stuff are going to be individual things. This is once you kind of are gone to the buffet and you realize, you know what, I really like this particular dessert, or I really like this particular main dish. Maybe that's where you start getting into individual stocks, individual futures, maybe options. But if you're just starting out, I would advise, just like against cryptocurrency, I would advise against individual stocks. start more conservative. This is really where you're going to have that introspection on your risk tolerance and what it means to you and what you're comfortable with. Now, one of the areas that I like to recommend for investors or for people that are out there building your portfolio, building your holdings are ETFs or exchange traded funds. So these are, think of them like baskets of a particular thing that are traded on exchanges. So they're a fund that represents a set of things and you can buy. So when you buy one of these things, you get a little bit of a bunch of things. This is kind of like that buffet admission. You get more than you might be interested in, but it gives you a good exposure to a lot of things you are interested in. And so these go in varying degrees of risk. I would call them theme ETFs, sector ETFs, and index ETFs. Each one of those getting less and less risky as you go down. So a theme ETF, that is going to be an exchange traded fund that is focused on a particular theme. Maybe it's solar energy, maybe it's nuclear energy, maybe it is consumer discretionary. As far as like discount consumer funds, maybe it's solar powered stuff where the basket is, solar panel companies, electrical distribution companies, things like that, right? So all of these themes are there. And depending on what the theme is, it can be pretty narrow. Therefore, its risk can be a little bit higher. And the best way to really kind of understand that risk is going to be on the potential rate of return. As you move down into sector ETFs, what I mean by this is take a particular category. Maybe it is large cap stocks. So these are going to be your stocks that have market capitalizations over some dollar amount, $1 billion. So comprised only of stocks whose market cap is over $1 billion. Those would be large cap type stocks. Or maybe you want mid cap stocks. So this is where the market capitalization of the company is within a particular range. So it's not focused on any one particular area, but of all of the companies of a particular size. And that's where you can kind of get into decomposing these rocks down into different smaller and smaller components. Now, probably where I think a lot of individual investors for just starting out are going to want to look is going to be your index ETFs. These are going to be exchange traded funds that focus on tracking a particular index, whether it's the Russell, which is a small cap index, or the S&P 500, which is kind of a general market index, or maybe the Dow, or maybe the NASDAQ, right? These are going to be very, very large baskets that cover entire indexes. So these are not going to have massive rates of return, but they're also going to be very much lower risk compared to individual companies. So if you look at, say, a stock chart look at Tesla, right? It's going to go up and down and up and down. Whereas if you look at the S&P or the SPY, which would be an ETF that tracks the S&P, you're going to look and it's largely going to go up and to the right, constantly building over time. Sure, it's going to have pullbacks here and there, but generally speaking, it is an up and to the right chart. And this is really where you probably want to start looking at index ETFs if you're just building your portfolio. So I would recommend starting here and looking below it on the risk scale. Like I said, it is much, much easier to take on future risk than to start off super risky and back down from the risk because you might find yourself really scarred from some of the things that might come out of taking on too much risk than your comfort level is good with. So the next big rock area that I want to break apart are bonds. And this is somewhere where I just think the people starting out don't really have a good concept of what are all the different type of bonds that are out there. So remember, the bonds are basically IOUs. And then depending on the type of IOU that is being issued out, it's going to go from more risky to less risky. And the most risky ones are going to be junk bonds. Now, junk bonds don't really mean they're absolute junk and you can throw them away. It basically means that these are companies that are issued or bonds that are issued where there is a high probability that the company is not going to be able to repay them. They still have a contractual obligation to pay it. There is just a higher probability that is going to end in a court case and a bankruptcy, things like that. So you can equate this to a bank giving a loan to somebody with a poor credit score. Those would be a higher risk loan. So the interest rate or the coupon rate on these are going to be significantly higher. Now, maybe that's a risk that you're willing to take because, again, it's the probability is there that they could default and not pay back the IOU, but that risk is less than, in many cases, some of the stock risks that you're going to take on. So in many cases, that is. Now, if you're a little bit uncomfortable with that IOU, you move up a little bit more on those bonds to a lower risk investment grade bonds. So you'll hear of different, AA rated, AAA rated, double B rated, right? These are all going to be particular analysts and the bond issuance and what is the rating of that bond. And each of those ratings are going to correspond to a different level of risk. So this is where going to that Just Get Started episode before, where you've opened up your brokerage account, go into that brokerage account and start looking at the bonds of what's out there. Start looking at the AAA rated bonds, read about them, understand how that report is and what that signifies. As you move lower risk than investment grade bonds, you're going to start getting into municipal bonds. Now, municipal bonds are basically IOUs, but they're IOUs from a city, a state, a government agency, not the federal government, but some sort of state government, local government. So again, governments have a lot of obligation to not default. They have a lot higher probability that you're going to get them paid back. So the coupon rates are going to be a little bit lower than investment grade bonds because it's going to be less risk, but they're going to be a little bit more risky and have higher coupon rates than, say, the United States Treasury, which is kind of the gold standard in risk-free type of rates. And then the very last bond, which is probably the type of bond that most people have heard about, are going to be your U.S. Treasury bonds. So this is going to be your 2-year notes, your 10-year notes, your 30-year notes. These are literally IOUs from the United States government and the associated coupon rate. Now, the coupon rates in many cases of the short-term bonds are set by the U.S. Federal Reserve. So this is what you hear about every so many months when it comes to the Federal Reserve and interest rates. They are setting the coupon rate for these particular bonds that the federal government will sell. Now, the longer dated bonds are more determined by an auction versus the actual setting of the short-term rates. But again, these are going to be IOUs issued by the United States Treasury. There are other bonds and foreign bonds and stuff like that. But again, that strays outside of this stratification of different levels of asset or different risk classifications of assets. So that brings us to the end of episode number 2 of the Investor Miniseries around understanding risk and understanding the asset classes and risks associated with it. We did not deep dive into a lot of this, but we started with those big rocks, and then we started breaking that first round of big rocks into smaller rocks. And really what you can do with this is go into that brokerage account that you've opened up from episode 1 and start looking for these type of investment things. Now, your broker will have screeners in there of ETF screeners, stock screeners, bond screeners. Start looking at those. Everything is going to have an associated thing called a prospectus. That's going to be a piece of paper that's going to define exactly what that fund invests in, exactly how that fund invests in it, exactly what some of the risks are associated with it. Almost all of the full service brokerages, especially Fidelity and Charles Schwab, which are the 2 that I recommended you open, are going to have free access into Morningstar reports. Morningstar reports are excellent reports put out there by the firm Morningstar. They go through composition, risk, they do peer analysis. What I would encourage you to do is go into those, read about them, look at them, see them. You don't need to purchase any of that stuff yet, right? Just start looking at them, and just simply having the brokerage account open is going to give you access to all of those screeners. It's going to give you access to all those reports. You can start reading about it, exposing it in future episodes, particularly by the time we get to episode 5. I am going to pull up individual Morningstar reports of underlyings that I've looked at that I'm going to go through a screener to say, hey, I want some large cap ETFs. How do I look at what's out there? How do I compare them? That stuff will be coming later on as we wrap up this series. But right now, you just have to start thinking about, well, what am I okay with? What is the rate of return on these things? And when you open up those prospectus, when you start going through the screeners, they're going to show you what is the historical aspect, historical return, the 5-year return, the 1-year return, the 10-year return. on each of those ETFs or bonds or different products, right? It's all going to be there in your brokerage. So I don't want to go through and click and show you all that stuff. I want you to go experience, go find it in your own brokerage that you've opened, see what it is. Next week, we're going to kind of dive into, okay, how do we start piecing this stuff together in making the decisions on what to purchase? We have done in episode 1 of starting the account. So we've created an account with the goal that we want to have in mind, the time horizon, and our risk tolerance. Now we've layered in a little bit of understanding what type of financial products are out there and where they fall on that risk scale of low risk to high risk. And we're going to use the scale of things relative to what we have decided is our risk tolerance from episode 1. And in episode 3, upcoming, we're going to start picking different products out of those categories to put into our portfolio to build it out. And we're also going to touch in episode 3 about whether or not we do it yourself or if you should go to a financial advisor and what the trade-offs are of those things. Either way, understanding everything up to this point is a prerequisite for going to a financial advisor, because the first thing they're going to ask you is, what are your objectives? What are your goals? What is your risk tolerance? And that's what we've kind of talked about so far in episode 1 and episode 2. So stay tuned for episode 3. Good luck out there. Have fun. And remember, think outside the block.